Megan is sitting at her kitchen table in Columbus on a Sunday night, staring at a student loan balance that still feels too large for her life, $30,000. The interest rate is 5.5%. She is 31 years old, an occupational therapist, and after years of feeling like every paycheck was already spoken for, she has finally found room. Rent is paid, groceries are covered, car insurance, health insurance, utilities, the 401k contribution she promised herself she would not stop. And after all of that, there is an extra $500 a month. Not a bonus, not found money, a real surplus, built from saying no to takeout, keeping the same phone, driving the same car, and tracking the small leaks that used to disappear without a name. So Megan makes the decision that millions of responsible people would make. She is going to send the entire $500 to the student loan every month. No games, no complicated strategy, just attack the balance until it is gone. At $500 extra per month, on top of her required payment, she can likely kill the loan in a little over 3 years. And when she imagines that last payment, she feels something she has not felt in a long time. Quiet. No more monthly statement. No more interest charge. No more feeling like a decision she made at 21 is still collecting rent from her life at 31. To Megan, this is what smart money looks like. Across the country in Raleigh, Jordan is looking at almost the same screen. He is 32, a software support manager, and his student loan balance is also $30,000. The interest rate is also 5.5%, and after rent, groceries, insurance, and his own 401k contribution, he also has an extra $500 a month. But Jordan does something different. He pays the required amount on the loan and sends the extra $500 into a low-cost S&P 500 index fund. He is not ignoring the debt. He is not pretending the loan does not exist. He is making a comparison. If his student loan costs 5.5% and the stock market has historically returned more than that over long periods, then maybe the smarter move is not to rush every spare dollar into the loan. Maybe the smarter move is to buy ownership, month after month, share after share, while time is still on his side. Jordan tells himself that if he waits until the loan is completely gone before investing seriously, he will lose 3 of the most valuable years he has, not because 3 years feels long. But money invested at 32 has decades to grow. So now there are two people with the same loan, the same interest rate, the same age range, and the same $500, and both of them look responsible. Megan's choice looks smart because it is guaranteed. Every extra payment lowers the balance. Every payment removes future interest. No recession can take that away. No bad earnings report can erase the progress. No market crash can turn a lower loan balance back into a higher one. Her win is visible, clean, measurable. Jordan's choice also looks smart, but for the opposite reason. He understands that not all debt is the same. A 5.5% student loan is not a 24% credit card. He is looking at the spread between what the debt costs and what investing might earn. If the market earns 8% over time and the loan costs 5.5%, the difference is 2.5 percentage points, at least in theory, and that is where the problem begins, because neither Megan nor Jordan is obviously wrong, but neither one is seeing the full picture. Megan sees the interest on the student loan. She sees the 5.5%. She sees the balance shrinking. What she does not see is the compounding she gives up by delaying investment of that extra $500. The money she sends to the loan cannot also buy index fund shares. It cannot participate in market growth. It cannot become the first dollars in an account that might grow for 20 or 30 years. Her certainty has a cost. Jordan sees the expected return of the market. He sees decades of compounding. He sees the possibility that his $500 can grow into something much larger than the interest he would save by paying the loan early. But he does not feel the taxes yet. He does not feel the volatility yet. He does not feel what it is like to watch his investment account fall 20% while the student loan balance is still sitting there, quietly demanding payment every month. His wealth may grow faster, but his financial life may feel heavier. That is the paradox. The person who becomes debt-free faster may end up with less wealth, and the person who builds more wealth may feel trapped for years because the debt never disappeared. Professor Wealth ran the numbers, and the first clue is simple. $500 a month invested for 3 years is $18,000 of contributions. If that money earns an assumed 8% annual market return before taxes, it could grow to roughly $20,300 by the end of year 3. That sounds powerful. But Megan's extra loan payments also earn a return, not in an investment account, not on a brokerage statement, but by avoiding interest. Every dollar she sends to principal gives her a guaranteed return equal to the loan rate, 5.5%, because that is interest she never has to pay. So the question is not, should you pay debt or should you invest? That question is too simple. The real question is this: is the guaranteed after-tax return from paying down the debt better than the risky after-tax return you expect from investing? Two $500 payments can leave two checking accounts on the same day. One erases a loan balance, the other buys future ownership. And the smarter move depends on the interest rate, the taxes, and how long the money has to work before you need it. Professor Wealth ran the numbers, and the first thing he noticed was that Megan's choice is not emotional nonsense, it is math. She has a $30,000 student loan at 5.5%. On a standard 10-year repayment schedule, her required payment is about $326 a month. If she pays only that required amount, she will send money to the loan for 10 years and pay roughly $9,070 in interest. That is the baseline. But Megan has carved out an extra $500 a month. So instead of paying $326, she pays $826. Now the loan does not last 10 years. It disappears in about 40 months, a little over 3 years, and the interest bill changes completely. Instead of paying roughly $9,070 in interest, she pays about $2,930. That means her extra payments save her about $6,140. This is why debt payoff feels so powerful. Megan does not need a stock market forecast. She does not need a perfect economy. She does not need the Federal Reserve to do anything helpful. Every extra dollar she sends to principal avoids future interest at 5.5%. That is a guaranteed return, not a hoped-for return, not a historical average, not a chart that looks smooth only because it covers 40 years. A guaranteed 5.5% after-tax return, and the psychology reinforces the math. Her balance falls every month. The statement looks better every month. The finish line moves closer every month. If the market drops 20%, her progress is still there. But there is a hidden ceiling on the win. Megan's extra payments can only save the interest that would have been charged. Her victory is real, but it is caped. In this case, that cap is about $6,140 of avoided interest. At month 40, she has something valuable. She has no student loan, but she also has no investment account built from those $500 payments. Jordan starts with the same numbers, same $30,000 loan, same 5.5% interest, same required payment of about $326, same extra $500 a month, but he does not send the extra $500 to the lender, he invests it. Assume he uses a low-cost S&P 500 index fund and assume an 8% annual return before taxes. Not because the market promises 8%, it does not, but because 8% is a reasonable long-term planning assumption before adjusting for taxes and volatility. Over the same 40 months Megan uses to destroy the loan, Jordan contributes $20,000. At an 8% return, that investment account could grow to roughly $22,900. That sounds like Jordan is winning, but then you look at the other side of the page. Because Jordan has only been making the required student loan payment, his loan is not gone. After 40 months, he still owes about $21,700, so his position is not simply, I have $22,900. His position is, I have $22,900 invested, and I still owe about $21,700. Net the two together, and he is ahead by roughly $1,200 before taxes and before any market decline. That is the uncomfortable part. The all-investing strategy looks much more sophisticated. It feels like ownership. It feels like long-term thinking. It feels like Jordan is letting compounding work for him. But during the first 3 years and 4 months, the visible advantage is not huge. And if taxes and fund drag reduce his real after-tax return from 8% to something closer to 7%, the account might be closer to $22,500. Now his edge is closer to $800. If the market only averages 5% during that window, the edge nearly disappears. This is not an argument against investing. It is an argument against pretending the spread is larger than it is. A 5.5% student loan is not a credit card, but it is also not free money. So there are really three paths. Same starting point. $30,000 loan, 5.5% interest, $326 required payment, $500 monthly surplus, 40-month horizon. Path 1 is Megan's path. Pay $826 a month to the loan. Around month 40, the student loan is gone. Compared with the original 10-year schedule, she avoids about $6,140 of interest. Clean, certain, emotionally simple. Path 2 is Jordan's path. Pay $326 to the loan. Invest $500 a month. At an assumed 8% before taxes, he ends with about $22,900 invested and about $21,700 still owed. On paper, that is roughly $1,200 ahead before taxes. Mathematically ambitious, emotionally messier. Then there is the third path. Split the difference. Pay $576 a month to the loan and invest $250 a month. At month 40, the investment account might be around $11,450 before taxes, assuming the same 8% return. The remaining loan balance might be around $10,800. Net position, roughly $650 positive. This path does not maximize the spreadsheet, but it does something spreadsheets often ignore. It reduces regret. The borrower sees the debt falling faster than the minimum payment schedule, but they also see an investment account growing. They are not completely absent from the market, and they are not completely ignoring the loan. That matters because the best financial plan is not the one that wins in a model. It is the one a real person can keep doing when life gets expensive, the market falls, and the loan statement still shows up. Now change only one number. Keep the $30,000 balance, keep the $500 monthly surplus, but instead of a 5.5% student loan, make it a 22% credit card. The answer changes immediately. At 22%, the debt is not competing against a modest expected investment return. It is negative compounding working against the household every month. On a $30,000 credit card balance at 22%, the first year's interest can be around $6,600 if the balance stays near that level. Now compare that with investing. If Jordan invests $500 a month for 1 year at an 8% annual return, he contributes $6,000 and might end up with around $6,250. That is about $250 of growth. Meanwhile, the credit card can generate thousands of dollars of interest. The investment gain is not even in the same room as the leak. This is where the always invest because the market returns more argument breaks. The market may produce 8% over long periods. It does not promise 22%. It especially does not promise 22% after taxes, with no volatility, exactly when you need it. Paying down that credit card is a guaranteed return equal to the interest avoided, and 22% guaranteed is extraordinary. That is why high-interest debt gets attacked first, not because investing is bad, because the spread is too large to ignore. Now change the debt again. Make it a 4% fixed mortgage. Same $500 a month. Same desire to be responsible. Very different math. If a homeowner sends an extra $500 a month toward a 4% mortgage, they are earning a guaranteed return of about 4% by avoiding future mortgage interest. That feels good. It reduces debt. It builds home equity. It makes the monthly statement less intimidating. But now, the competing investment has a much longer runway. If that same $500 a month is invested for 30 years at 8% before taxes, it can grow to roughly $745,000. At a more conservative 7% after-tax return in a taxable account, it is closer to $610,000. At 6.5%, closer to $555,000. The mortgage payoff is still a real return, but the opportunity cost becomes enormous because time is doing so much of the work. This is the illusion of low-rate mortgage debt. The mortgage feels risky because the balance is large, the payment is visible, the debt is attached to the house, it carries emotional weight. But the compounding you give up by prepaying a low fixed-rate loan is invisible. Nobody sends you a monthly statement that says, "Here is the future wealth you did not build." So the question is not, should everyone keep a mortgage forever? No. The question is this debt expensive enough to beat the after-tax return I reasonably expect from investing? At 22%? Yes, pay it off. At 4%? Often no. Invest alongside it. At 5.5%, like Megan and Jordan, it depends. And this is where taxes, fees, and risk decide whether the spread is real. Debt payoff is clean. If the loan rate is 5.5%, the avoided interest is 5.5%, guaranteed. Investing is not clean. An S&P 500 index fund might have a tiny expense ratio, maybe 0.03%. That part is small, but taxes can matter in a taxable brokerage account. Dividends may be taxed along the way. Capital gains may be taxed when shares are sold. A Roth IRA can improve the after-tax result. A 401k can improve it too, especially if there is an employer match. But retirement accounts may come with restrictions, contribution limits, and less flexibility. So you cannot compare a certain 5.5% loan rate to a headline 8% market return and declare victory. That is not an equal comparison. Jordan's real question is whether the extra return after taxes and costs is large enough to compensate him for uncertainty. If 8% becomes 7% after taxes, his advantage over the 5.5% student loan is only about 1.5 percentage points. On $500 a month over 40 months, that is why the edge is only around $800 to $1,200. The long-term result depends on what happens next. If Megan pays off the loan and immediately redirects the full $826 into investments, she can catch up faster than people expect. But if the loan disappears and the old payment quietly becomes restaurants, upgrades, vacations, and a larger car payment, then Jordan pulls far ahead. The math does not end when the loan ends. The freed up payment has to be assigned a job. So the practical rule is simple. Pay the minimums on every debt first, because late fees, penalty rates, and credit damage can erase the benefit of any clever strategy. Keep emergency savings, because if every extra dollar goes to debt and the car breaks down, the next surprise goes right back onto a credit card. Then rank each dollar by return. Anything above 7%, especially credit cards and personal loans, usually deserves aggressive payoff. The guaranteed return is too strong. For lower rate debt, invest alongside payoff, especially inside a 401k, up to the employer match, a Roth IRA if eligible, or low-cost index funds. And for middle-rate debt, like a 5.5% student loan, the split strategy can be the most human answer, not because it is mathematically perfect, because it is durable. And a durable plan held for 5 years often beats a perfect plan abandoned in 5 months. Megan and Jordan are back at the same moment, same checking account, same $500 surplus, same feeling that the responsible thing is to send the money away before life finds a way to spend it. Megan sends her $500 to the student loan, and month by month, the balance falls faster, the statement gets cleaner, the finish line moves closer. Eventually, the debt is gone, and that freedom is real. Jordan sends his $500 into an S&P 500 index fund. He owns more shares each month. His future net worth may be growing faster, but the loan is still sitting there, still charging 5.5%, still showing up on the screen like unfinished business. What Megan missed is that paying extra was not automatically the most responsible move. It was a guaranteed 5.5% return, strong, clean, and certain, but not unlimited. What Jordan missed is that a higher expected return is not the same as a painless return. The market does not move in a straight line. Taxes can reduce the spread, and owing money while watching an investment account drop can make the smartest spreadsheet feel like the wrong life. That is the mechanism both of them were really facing. This was never debt versus investing as a moral choice. It was a return comparison. Debt payoff gives you a guaranteed return equal to the interest rate you avoid. Investing gives you an expected return that must survive taxes, fees, volatility, and your own ability to stay invested. So the practical rule is simple. Pay the minimums on every debt. Protect your credit, avoid fees, keep emergency savings so the next car repair does not become a credit card balance. Attack anything above 7% aggressively because that guaranteed return is hard to beat. With lower rate debt, invest alongside payoff when the after-tax expected return is meaningfully higher. And when the numbers are close, like a 5.5% student loan, choose the plan you can actually follow. Megan's $500 bought certainty. Jordan's $500 bought future ownership. Neither one was automatically smarter. If this video helped you see something you did not know was there, subscribe to Smart Money and hit the notification bell. We break down the hidden math behind the financial decisions you face every day. Debt payoff is certainty, investing is probability, and Smart Money knows which one the interest rate is actually offering.